Welcome to course number 10, Financial Planning and Goal Setting. In this lecture, we'll focus on short and long-term financial goals. Learning to set realistic goals is an essential skill for managing your money, building security, and creating the future you want. Financial goals give your money purpose. Without goals, money often gets spent without direction. By setting goals, you decide in advance how your resources will support your priorities, whether it's buying textbooks this semester, paying off loans, or preparing for retirement decades from now. Short-term goals are objectives you want to achieve within a year. For students, this might include saving $500 for an emergency fund, paying off a credit card balance, or budgeting for a spring break trip. These goals are achievable in the near future and help build financial discipline. Common short-term goals include creating and sticking to a monthly budget, building a starter emergency fund, saving for holiday gifts, or setting aside money for school supplies. These goals give you quick wins that motivate you to continue managing your money wisely. Long-term goals typically take several years or even decades to achieve. Examples include paying off student loans, buying a home, starting a business, or saving for retirement. Long-term goals require consistent effort, planning, and often involve larger sums of money. For students, long-term goals might include graduating without excessive debt, building strong credit, saving for a down payment on a house, or contributing to a retirement plan early. Even though they may feel far away, starting now makes these goals much more achievable. Successful financial planning requires balancing short and long-term goals. If you focus only on short-term spending, you risk sacrificing your future. If you focus only on long-term savings, you may not have enough money for today's needs. Smart planning strikes a balance between the two. A useful framework for goal setting is SMART: specific, measurable, achievable, relevant, and time-bound. For example, instead of saying, "I want to save money," a SMART goal would be, "I will save $50 a month for the next 6 months to build a $300 emergency fund." Let's consider Sam, who sets a short-term goal to pay off a $200 credit card balance within 3 months by cutting back on eating out. Sam also sets a long-term goal to save $100 a month in a Roth IRA for retirement. These combined efforts give Sam both immediate success and long-term financial security. By setting both short and long-term financial goals, you take control of your money instead of letting money control you. Goals provide motivation, accountability, and a clear direction for your financial decisions. They connect today's habits with tomorrow's opportunities. To summarize, short-term goals build financial discipline and quick wins, while long-term goals focus on major life achievements. Balancing both is essential for success. By using SMART goals, you can create a financial roadmap that supports your values and builds a secure future. This concludes our discussion about short and long-term financial goals. In the next lesson, we will learn about retirement savings, 401k, IRA. See you then.